So, whether you're a Canadian or an American, you've likely heard that Canada's Big Five or Big Six banks are very stable dividend paying investments. So, in this video, I'm going to show you how you can gain exposure to all six of these banks in a single click through 3 Canadian bank ETFs. So, that being said, let's get started. So before we get started with the video, just as a reminder, subscribe to the channel if you like it, smash that like button. We're creating a bunch of ETF content recently, so most importantly, so we know if we can continue to create it or not, drop a comment down below and let us know if you like the video. So with these Canadian banking ETFs, there's a lot of debate as to whether or not these ETFs are worth holding. And that is because, for the most part, they only hold 6 holdings. So, for example, ZEB, one of the ETFs we're going to talk about, it only holds 6 stocks. So, in order to replicate an ETF like ZEB, all you really need to do is spend $30 on Questrade, and this in the end can save you a lot in terms of annual fees. These Canadian bank ETFs, in my opinion, are suited for a very specific set of investors. For one, they're for those who don't necessarily have enough capital to invest in the 6 banks appropriately. So if you only have $1,000 and Questrade is charging you $5 per trade, it doesn't really make sense to take that $1,000 and branch it out over all 6 banks. A small allotment could be used to buy a ETF like one that tracks these 6 banks specifically. But if you have, $10,000, $20,000 to invest in the Canadian financial sector, particularly those in the Canadian banks, you're going to find it much cheaper to just purchase the banks themselves. You can head over and find the specific holdings of these banking ETFs and essentially mimic them in your own portfolio. And who else would these ETFs be better suited for? Well, that would be primarily for those who definitely need the monthly distribution. So for those in retirement who would rather have monthly income, these ETFs provide a much better solution. All of the Canadian banks, the 6 major Canadian banks, they pay dividends on a quarterly basis, whereas with these ETFs, you're going to get a monthly distribution. So if you don't have a very big portfolio, it doesn't make sense for you to individually purchase and balance the big 6 banks, or if you're a retiree who's looking for that consistent monthly income, then these ETFs are definitely for you. And we're going to get into our first one, arguably the most popular one, and that is ZEB. So ZEB is a BMO product. It's a equal weighting BMO product. That's why they call it the equal weight bank ETF. And we can see this if we look towards the holdings. It isn't exactly equally weighted, but it is relatively close. The Bank of Nova Scotia at 18.38 makes up the largest portion of this ETF, and if we get to the bottom end of it, 14.59% goes to National Bank. So as you can see, this Canadian banking ETF strictly holds the 6 biggest banks, and as of right now, it pays a 4.14% dividend yield, which is less, actually pretty significantly less than what you would get investing in these 6 banks directly. If you did purchase these banks and kept this allocation the same as per the holdings, you would yield more. This is what you give up when you do buy an ETF like ZEB. I'm not going to go over the exact differences right now because you could be watching this video a day after publishing or 6 months after publishing. So I just want to let you know that you will be receiving less yield than if you were to just buy the stocks directly. And this ETF does have fees of 0.55%, meaning that you are going to pay $5.50 for every $1,000 invested on an annual basis. So it does eat away a little bit, the fees and the lack of overall yield, but overall this actually has been the best performing Canadian bank ETF out of the 3 that I'm going to go over today. If we look to its total returns, ZEB over the last 5 years has returned 71.6%. This is significantly more than the 41.2% that the TSX index has returned, And more surprisingly, on a dividend adjusted basis, ZEB, which is strictly a Canadian bank ETF, is returning more than ZWB, which is going to be the one we go over next, which utilizes a covered call strategy. That ETF has only returned 56.8%. So covered call ETFs are very popular to some because they generate higher distributions, but it's important to understand that we are looking for overall return here. So not all covered call ETFs provide better returns. And in this case, this definitely is the case. So ZEB, in our opinion, is actually one of the best Canadian banking ETFs if you're looking for one-click exposure to the sector. If we head back to the holdings here, we can see that National Bank is, despite being the best performing Canadian bank, the lowest holding. So there is a chance that if National Bank was boosted inside of this ETF, it would likely have much better performance, especially when we consider that the Bank of Nova Scotia, the worst performing Big Five bank over the past while, is the largest percent holding. So this is something to consider if you want to essentially make up your Canadian banking exposure a little bit different of a way, as in more exposure to a top performer like National and less towards a bottom performer like Bank of Nova Scotia. This would be hard to do purchasing this ETF. Any banking ETF, really. There isn't much to talk about ZEB. It's pretty straightforward. A little bit high fees and sacrificing yield, but let's move on to our next option, which would be BMO's covered call variant, and they trade under the ticker ZWB. So before we get into this covered call ETF, it's important to understand what a covered call is. And by no means is this going to be a full in-depth guide, but essentially a covered call is when you own the underlying shares of the company and you sell a call option. In return, you get a premium from the call option buyer, the person who buys that options contract from you. And these ETFs utilize this to generate more income and pay out higher distributions than an ETF like ZEB. And we can look no further than just comparing the two overall distributions of the ETFs. ZEB, at the time of filming this, yields in the low 4% range, 4.14%, while ZWB yields 5.8%. So this is quite a higher distribution, and a lot of those who are looking for more consistent monthly income might choose the covered call option, like ZWB. And if we look towards management fees, ZWB also does charge a higher fee. This makes complete sense because it is more actively managed. The managers of this ETF are consistently selling call options inside of the ETF. More work equals more fees in almost all cases, and ZWB has fees of 0.65%, which means on an annual basis, you'll pay around $6.50 for every $1,000 invested. So if we look to the overall holdings of this ETF, we can see that its number one holding is actually ZEB. So the number one holding inside of this covered call ETF is its non-covered call variant, ZEB, the ETF we talked about before. And then after that, many of the holdings are the same. We see that Bank of Nova Scotia is the top, followed by Bank of Montreal, TD Bank, Canadian Imperial Bank of Commerce, Royal Bank, and National Bank. And the one thing about ZWB right now is the two best performing banks in quite a while here in Canada are the lowest holdings inside of this ETF. So likely if these were at the top, this ETF would have performed much better. And as I'm filming this right now, it actually has one of the covered calls that it is sold inside of this portfolio. So as I mentioned, in terms of overall performance, ZWB has underperformed, and it's actually the worst performing bank ETF on this list that we're going to talk about. ZEB, the non-covered call variant, has outperformed it significantly. And this is important to understand that if you don't absolutely need the higher distribution, you simply want exposure to Canadian banks, then ZEB might be the better alternative. Don't get caught up in the high yield of this covered call ETF. So that's pretty much it for the BMO variants of these banking ETFs. We have the non-covered call and the covered call variant. And now we're going to move on to CI First Assets variant. They trade under the ticker CIC on the TSX. So CIC is a Canadian banking ETF that also does sell covered calls. So you're going to get a higher distribution. In fact, I think the ETF yields over 9% at the time of filming this video, and you're also going to be paying higher fees. It does have the exact same fee structure as ZWB, $6.50 on every $1,000 invested. And the one thing I really like about this ETF is I do like the overall holding allocation more than, say, ZWB and ZEB. And if we look to the holdings, we can see that the number one holding, instead of it being Bank of Nova Scotia, is TD Bank at 16.77%. The Royal Bank of Canada is third at 16.51%, and National Bank of Canada is fourth at 16.50%. But the one thing to take away from all of this is, although ZEB is supposed to be an equal weighted fund, CIC is actually much more equally weighted. As we can see, between the top holding and the bottom holding, there's only about 0.5% difference. And as we can see here in the holding again, we can see the covered call options that they currently do have. We can see a $110 call on Royal Bank expiring February 19th, 2021. National Bank, a $74 cover call at the exact same expiry. So it is interesting that you can go in and view the call options that these ETFs currently have. Again, if these expire useless, they essentially collect a premium. They don't have to sell the stock. And as a result, investors get higher distributions investing in this fund. But again, it's very important to look at overall returns. And CIC, although it has performed better than the ZWB alternative, it still has underperformed ZEB, which is strictly the investment in Canada's big six banks. So again, if you absolutely need the distribution, you can opt for these covered call variants, but the true best real return Canadian bank ETF thus far has been ZEB. Now, another thing to note about CIC, it is the least traded out of these three, actually by a landslide. It only has daily volume of around 33,000 shares, whereas ZEB has volume of around 750,000 and ZWB around 120,000. But 33,000 shares trading hands every day, this shouldn't pose a liquidity issue for most retail investors. So ultimately, I would rank it just ahead of ZWB if you are looking for a pure covered call bank ETF. But overall, that's pretty much it for the video. I mean, these are three very simple ETFs. They don't require much research into them. They simply hold the top 6 Canadian banks. The only choice you really have to make is, do you want the pure real return in ZEB, or do you want a higher distribution covered call variant in CIC or ZWB? They all have very equal fees. These are high fee ETFs at 0.55% being the least with ZEB, and if you do have a lot of capital, it might be wiser for you to just purchase the banks in themselves and pay a one-time commission fee instead of an annual expense. Overall, great way to gain one-click exposure to essentially one of the best financial sectors in the world. I mean, we can look to a company like Royal Bank. They've paid consistent dividends since the early 1800s. So again, smash that like button, head down below, subscribe to the channel, but most importantly, drop a comment down below and let us know if you're liking the ETF content, and even more importantly, what ETFs do you own in the Canadian financial sector. And again, we'll see you next time with more great Canadian content.